What's going on, everyone? My name is Nicholas Merton here at Data and today is May 6th of 2019. Well, folks, I hope y'all are having a fantastic day wherever you are, and today we've got a very key topic to focus in on, and that is the current state of equity markets. Now, I want to spend some time not only to talk about the big headlines that have been going through over the last few hours that are actually leading the futures for most indices down 2%, but along with that, we're going to be focusing in on cutting out the noise and really getting down to the substance material. So without further ado, let's go ahead and dive right into it right after our quick sponsor.
Okay. Oh. All right.
Everyone, so let's go ahead and dive into this topic and talk about what's going on in equity markets in regards to price first, and then we'll dive into a few other things as well to kind of paint the picture as to where we are. So it doesn't really matter whether you're looking at the NASDAQ, the Dow Jones, and the S&P 500, guys. Markets are pretty much at all-time highs, or they're holding towards their all-time highs. So the NASDAQ here, we printed all-time highs here the other day. The S&P 500 up here, all new highs, and the Dow Jones pretty much topping out at a range we've seen 2 times before, looking like it might be setting up a triple top, which can tend to be a very bearish pattern. But I want to emphasize throughout this video, guys, I'm not going to sit here and have a predetermined view as to where markets are going. As a trader, I'm basically in a range where I'm in the neutral zone. We're back at where we've seen us test before, and in some cases, this can lead to great breakouts. In fact, I have a theory I wrote about in the newsletter where we might actually see the NASDAQ, which is currently at around an 8,000 point range, possibly just go up another 25% to 10,000 points. It could very well do that. That would in fact be double of where we were during the dot-com era, where we topped at around 5,000 points on the NASDAQ. But putting that aside, why am I keeping this neutral view? And also, what's leading me to talk about equities today? Well, there is some recent price action that's going to be applied to markets in just a few moments on actual publicly traded markets. We're currently having to look at futures here because it's 9:23 in the morning. We can see here, though, that the NASDAQ is down 2%, the S&P 500 down 1.6%, and the Dow Jones down 1.8%. So what's leading to this pretty stark sell-off overnight, and over the weekend in this case? And what is it, catalyzing in markets? Well, it has to do on trade talks, supposedly. This is 2 articles from Bloomberg talking about how 2 simple tweets have brought down the market, in fact referring to the fact that Trump had basically talked about increasing tariffs on high-tech products for China, which is a pretty big market in regards to imports and exports between China and the United States. So this means in this case there's going to be more tariffs applied to the economy. Now, I want to skip all the kind of BS and arguments, guys, and a lot of people have very stark opinions on this because anything to do with politics or geopolitics is going to be quite controversial, and some people would say this is a good thing and a bad thing. I want to cut out the noise, guys. I'm going to make 2 major points here. Not only do I believe that this is not the major reason that equities are dropping in this case, I think it's a catalyst that started to lead other factors to start to weigh in on markets earlier than people had expected. But the second thing that I want to talk about as well is an interesting theory, which we'll dive into. So first point here that I'm making in this case is what's really holding down markets, guys. Tariffs are not usually good in the long term. They're usually used as a leveraging system to lead to eventual negotiations. That's what Trump's been trying to do. Whether or not it's going to work or not, we'll have to see. But it is used by a lot of governments in the past. And to be fair, a lot of countries haven't had fair tariffs against the United States. We've had trade deals on a lot of different markets, and it turns out that a lot of people start charging tariffs on us. It just doesn't get reported on. Anyways, the major thing here that I want to talk about here that's really weighing down markets, guys, is that the Fed did not provide stimulus to the market back last week when it had its FOMC meeting. We kept rates pretty much unchanged. In fact, slightly rose them a tad bit by pretty much 10 basis point in this case, or sorry, 10 basis points. And we also had the Fed balance, or not just the Fed balance sheet, the global central bank balance sheet, really taking in the major ones here, the Fed, the ECB, and the Bank of Japan, continuing to deplete the assets they own, right? Over the last year and a half, we've had about $1 trillion of sell-side pressure, in this case, in regards to basically federal government balance sheets, or basically central bank balance sheets. The major point I want to bring to this and why this is significant, because a lot of people don't really get, why is that significant? It's still quite high up here. The reason why that's significant is it means that that's $1 trillion of cash that would have possibly been going into equity markets that are going into buying up the treasuries that these central banks are selling, that are going into buying the mortgage-backed securities, all kinds of assets that the central bank is taking off. So it relieves cash from equities that could be going to buying up equities and propping up prices, right? Again, markets are a game of inflows and outflows. If it gets more expensive to borrow capital, people stop borrowing and they stop buying stocks. If money is going into fixed income markets that are being dumped by central banks, it's not going into risky assets like stocks, right? So this basically is leading towards a sell side pressure. And when it comes to having catalysts like we have, for example, this talk about trade tariffs and the trade war, just getting started, not coming into a resolution anytime soon, it can be reflected. It can be basically a catalyst to lead to some of this action coming into markets. Because what really matters, guys, is not always what's going on in the fundamental underlying economy. The fundamental underlying economy, though I think we've seen improvements, job numbers have been quite nice in some cases, and wages have finally started to rise a little bit. It's nothing substantial. It hasn't been for decades, right? This isn't something about politics or anything like that, guys. It's the fact that what matters to equity markets does not matter to traditional Main Street. Wall Street and Main Street have two different things. Wall Street's a simple game of inflows, and the rules right now are not in favor of inflows. So what's kept up equity markets over the last few months, since back in December when we were selling off quite starkly, is basically the readjustment in the pension funds, the $64 billion buy-side pressure that readjustment had, the largest in history for equity markets. We also had as well, China and a lot of countries creating the largest amount of credit that we've seen in history in a single month. And you've also had, in this case, the Fed, flatlining its monetary policy, which did provide some relief, whereas it was raising rates during this time period. But there has to be something that's going to push markets higher. Stock buybacks aren't going to kick it. Equities are getting too expensive, right? They're going to have to spend much more cash to buy up a smaller amount of stock than they were able to previously during this period in 2017. So there needs to be something to give in markets. And you can even see, for example, one thing that Trump has pushed forward, whether or not it's good or bad for markets, doesn't really matter. He's wanted to see Jay Powell, the person he elected as the Fed chairman, to cut rates and possibly consider QE4, which I have no doubt would be including what I've talked about in my newsletter, which is that we're eventually going to, in some time in late 2019 or 2020, we're going to follow Japan-styled purchasing of ETFs and stocks. We're going to actually start buying up direct equities in the market. So here's my interesting theory. And again, you got to go down a little bit of a rabbit hole here. But there has been this dichotomy between Trump and Jay Powell right now. And I have a very interesting theory that as Trump has realized in this case that Jay, in this case, and the Fed, they do operate as a separate entity. The Fed does what it believes is best in this case. Whether or not that's for the banking sector and the financiers, doesn't really matter. They do operate on their own. They make their own decisions. I really think there's an interesting play here. Trump is realizing that he's got something here that will lead markets to go higher or lower and can lead the Fed to make some pretty stark decisions. If he continues to actually take upon this opportunity of strength in equities and also this dichotomy where the Fed is not going to reach to the monetary policy it wants, perhaps he's taking upon this opportunity to hold some extra leverage in the China trade deal and push equities a little bit lower and low enough to where the Fed might actually consider, due to the broader macro perspective, that rates need to be cut and definitely not risen anytime in 2019, or then we might have to actually start providing stimulus to equities, especially if we revisit back down to this range. I bet you good money if we actually test towards down this range and that's what's happening in the market, that we start to continue to have these severe fears of a China trade war weighing down markets, the Fed will do that. It will do one or two of those at least. The major thing I want to emphasize, guys, is that's why I don't play it one way. And this is where we have the potential for something like the NASDAQ reaching towards 10,000 here. If we see that stimulus here, if we come down, for example, down to these levels, that will be a monster rally from 6,000 to 10,000, guys. We would not want to miss out on that risk taking. And in fact, if it happens sooner up here at these highs, still 25% rally in equities is not a bad deal. I think we can definitely see that. I have no doubt we can see that if the stimulus comes into the market. And we can just see we just drop down here. Again, I think if you close below the 50-day here, or the 50-day moving average, you're probably bound here to go down to these lows, right? If the Fed doesn't act quick in its next FOMC meeting, we're not going to see markets continue higher. They're not providing the necessary stimulus that they needed. And this is why, and even the other day when stocks popped up here, the day after the Fed announcement, I was like, guys, don't get too eager on this. It's going to be very difficult for this to break to new highs. There's not much reason for it. There's not good risk to reward ratio for this. Down here, you had a good risk to reward ratio. Up here, not so much. So I'd like to know what you guys think. I know a rough idea about what institutions are thinking about this and some of the institutional traders that I know, but I'd like to know what you all think about this news. Do you think that the game of inflows and outflows is really what's at play here, or do you really think it has to do with the Trump tariffs, in this case on China? And what do you think is going to come out of that? Again, don't try not to think too much biased on it, guys. I know anything geopolitics, it can be that way. I'm very interested to see what happens. I think my summary on the trade war and what I think it's going to lead to, what I would hope it leads to, but also what I think is actually quite practical, is that we're going to have some pretty stark agreements in regards to China basically cutting down on IP infringement, basically, everyone having a fair level playing field. I don't think we want to have tariffs on one another. Basically, getting to the point where we stop having this issue. It's a game theory issue of the prisoner's dilemma, where basically people undercut one another if they think they can get something out of it. It's a really interesting thing. I recommend you look into it, guys. That's a good little topic to read up on, and basically how these countries come to agreements and then they try to undercut one another in this case, because it's a hope that, hey, the other person's going to play by the rules, but I don't have to, and I'm going to get away with making more money. And this happens with environmental policies, all kinds of things like that. But it can happen in markets and trade deals as well with tariffs. So, all right, I've rambled on enough, guys. Hope you all are having a fantastic day. Definitely leave some comments down below. If you like the video, please give it a thumbs up. I'd always appreciate it, guys. But until the next video, I will see you all in the next one. Stay tuned.